Cool. So, Frank, by the way, if you're going to stick around in the room, keep your mic on, because we're probably going to get questions in the next section, and I might deflect one or two of them to you. So, what I wanted to do to kind of wrap up and tidy up the money section of Underground Empire Builders is just share with you my 5 favourite wealth building strategies. So these are the 5 things that I'm doing. They're not the only 5 things you can do. They're certainly not the 5 things that everybody should do. But they're just the 5 things that I do, and I'll give you a little bit of reasoning as to why I do them. Some of them are based upon my disc profile, some of them are based upon my hobbies, but these are my 5. So first of all, whenever you're considering how you go about building wealth, and of course, Frank and Mark have predominantly done that through property, and of course Frank shared how he's diversified to spread the risk and make everything a little bit safer and more stable. The 5 that I use have varying degrees of risk. So I have some very low risk, safe, stable, predictable strategies, and I also have some higher risk, less stable strategies. And of course then some will get you will bring me a slower rate of return, and some will bring a faster rate of return. By the way, if you're let's go back to day one morning. If your high dominance profile, you stand in this corner a lot, which end of this line do you think you're most likely to go to? Just point to the end you're most likely to go to. High dominance wants the result as quickly as possible. You're going to spend your time top right, probably. If you're more high influence, so you reside in that corner there, probably again up towards the top right. If you're more steadiness or compliance, then where do you think you're going to favour or reside? What do you think? Shout out loud. Yeah, you're probably more likely to be down the bottom left. And as Frank's pointed out, you should also consider, of course, stage of life, what your goals are. If you're later on in life, then you're probably less likely to want to go high risk, high return. If you're younger, you can probably afford to go a little bit higher risk and high return. So these are my 5, and I'll explain what they are, and then give you a little bit of the thinking and the rationale behind it. And then maybe, if you've got a couple of questions, then feel free to ask and I'll answer, and I might bring Frank in as well. So, and by the way, these are not in the order I did them. In fact, if I remember correctly, I did them in the reverse order, which is not advice. That's just what I did. So, the first, and actually it's the last, the one that I've done probably most recently, because it's the most alien to me as somebody who's high dominance and wants the fast result. So the last one I've done, but it's the first on this graph, is index funds. So again, I'll explain this all in more depth shortly, but essentially investing money in relatively low return, but also very low risk areas. So index funds are, you can purchase or invest, let's say, £1,000 in an index fund. I use the Vanguard FTSE 100 tracker, and that basically means that for that X amount, 1,000, 10,000, 20,000, whatever you're putting in, you own a bit of all of the FTSE 100, which again just reduces risk. It diversifies. It means that you're not all in on one company that could go all the way up or could go all the way down. So that's something that I've started doing more recently. Again, on average over time, and Frank just shared what happens to property over time, each decade. On average over time, you could expect with anything like FTSE 100, S&P 500, the US equivalent, you're probably looking at somewhere around about the 10% a year return on average, which at the moment is pretty much just staying still. But at least it's not losing your money. And as Mark predicted, as interest rates, as inflation drops, then that 10% a year is looking more and more attractive and a bit better. So low risk, low return, but I put a certain amount of money in there every year. I use a FTSE 100 tracker ISA, which means any profits that are made are interest-free. You're allowed up to 20,000, I believe it is, per person. So myself and Nat, my wife, will do 20 grand a year each into those, which just basically maximises our allowance for tax-free purposes. And of course, you could, and I would suggest that you, if you're investing a significant amount more than that, that you would also look at other index funds. The reason though is because if you put all your money in one stock, by the way, stock picking, I don't care who you are, it ain't going to work long term. Like, I don't understand the stock market, and I doubt anyone in here really does at an advanced level. Even traders don't really understand the stock market. So stock picking long term is not going to, it's a high risk and high return strategy. I don't touch it. But how I benefit from the predictable increase in the stock market is using index funds. Second thing, we've talked about it a lot already. I am not the expert on this. You know, Frank, of course, and Mark, of course, have built massive wealth through property. But Frank just showed you one of my deals. And that there's been a few like that we've done recently that have done pretty well. And so, you know, put in relatively small chunks of money into property deals like the one he just showed you on the screen. And we're getting... bizarrely, the reason I never got into property sooner is because my belief was that it doesn't work like he just showed you, and that you can't get 70, was it 6 or 8%? 76? Yeah, should have been 78, Frank. You sold me a lemon, what can I say? No, 76% return year on year. I wasn't thinking that way. I was thinking that, you know, it's a very, very slow and steady strategy, but the risk is relatively low and the speed of return can be good. And equally, you know, wouldn't be as quick as some other strategies that I like to favour. So, property, I'm definitely doing more and more. My goal is to add 5 buy-to-lets per year to my portfolio for the next 5 years, and get our portfolio up into 30 odd properties. That's my goal. So I'm going to consistently and repeatedly do that process that Frank just showed you. Third, I'm just calling this other assets, and the reason I'm calling it other assets is because it really is a bit of a catch-all for anything that you might like to invest in. I actually think that building your wealth should also be fun. And that you might choose to invest in other assets that, yes, may bring a return, and yes, maybe slightly more risky, but you actually want to do. So, for example, I have a bit of a thing for watches, as you might have noticed. So I've purchased a few nice watches over the years, and that goes in my other assets bucket. And, you know, when you pick the right ones, and by the way, you might not care about watches, but you might care about classic cars, or you might care about art or wines or something like that. Could be really, could be a personal hobby of yours, but also something that, if you understand the market, can grow over time. Again, probably never going to explode, although, you know, if you pick the right thing, you never know. But there's an element of enjoyment about it. And by the way, something I learned from Frank is purchasing those assets inside a company, not doing it personally, which is what I did originally. And of course, if you can visualize Frank's slide of having the multiple businesses or vehicles at the bottom of the screen, one of those is an other assets company, which I use to purchase things like watches. Number 4 is business. Now, again, broad term, lots of other elements to this. So, of course, investing your money in your own business. If you were to invest 10,000 or 20,000, for example, in marketing, in advertising of your business, a couple of things could happen. Either one, you could get it completely wrong and you could lose all of that money immediately, or 2, you could nail it and you could get a 3, 4, 5, 10x on return on investment really quickly. Equally, so what I've done most over the years is I've reinvested in growing Expert Empires, the Elite Closing Academy, being our two main businesses. I've also invested in some other companies where I'm hands off and I'm not actually involved at all, because I like the company and I like what they stand for and I think they're in an interesting market. I believe they're going to grow. But when you don't have the control over the company, let's face it, the risk is higher. The rewards may be higher as well if that company really nails it and takes off. So, by the way, I have, interestingly, I never mentioned this earlier, I probably should. So Keep, part of my arrangement, part of my partnership agreement with Keep is that I have Keep stock. So I own a small, very small, in the huge scheme of things, part of that company. And so, I've done things in my core business to earn stock in businesses like Keep. I've also invested capital, actual cash in other companies that I like and I want to support and I want to be part of. And then finally, this one I just call punts. Speculative punts, I call them. And look, this is my high dominance. Like sometimes something comes up or I find out about an opportunity and I just want to go and punt some money at it. Because I go, it could fly, it could explode, it could go to the moon. I chucked some money into crypto a while back. I chucked some money into a fund that was performing phenomenally well, like crazy returns. Sometimes these things work out brilliantly and you're talking 5, 10 plus return on investment within maybe a few months or maybe a year. And look, there's a reason why the upside is so high. Is because the downside is equally likely. And so, I've many times over years plumbed money into things that I thought could explode but could also lose all my cash. And the irony, and I only really just realised this as I've explained it to you, is that I started probably the wrong way around. And I started off when I had very little cash doing speculative punts, chasing, it'd be like going into a casino, losing a bit, and then chucking more down on the table because I'm chasing the win. I'm trying to get a fast win because I'm such an impatient person. So I started off doing that, and then, of course, got a bit smarter and reinvested in the growth of our businesses. Then started to diversify out, invested in some other asset classes, and it's only been more recently, really. I think first property purchase was 2018, 17, 18, I think. And then have started to build the portfolio with Frank's help, and then it was actually only last year that I started getting into doing things safe, boring, dull, high compliance and conscientiousness strategies like index funds. So those are like my 5. They're the 5 that I do and that I use. So I suppose it'd be cool, maybe we've got a bit of time, maybe 10 minutes, to open this up for questions. I know there's probably loads of questions around Frank's presentation. Anything here, like as you've probably gathered over the last 2 days, I'm an open book. Happy to share anything with you that might help, or maybe advise what I would do in your position in particular. So yeah, over to you. What questions you got around any of this? Let's start with Matt here, and then next, if we can get the mic ready, we'll go to Ben. And yeah, we'll make our way around. Matt?
Yeah, I've heard about investing in watches. I've never heard about buying in a company, though. So I was curious to what's the benefit of buying the watch in a company rather than in your own name?
So, Frank, I don't want to sell you short, but I also don't want to sell myself short. Who kind of worked this out, you or me?
I think it was a really good combined effort, actually.
I do. I really do. So here's what happened. I saw Frank give a version of the presentation that he's just given to you. And I went, I get what you're saying. And I've got assets that are owned by, if you can remember Frank's slide, like me, up the top. And I'm like, that's not very smart, that's not very protected. And I went, so I think what you're saying, Frank, is that I should always buy assets in a company. He went, correct. I went, great, so what about watches? He went, yes, should definitely buy them in a company. I went, okay, cool. And then as we explored it, I went, so hold on a second. If I own these watches personally, and I want to put them into a company, then aren't I selling the watches to the company? He went, yes, you are. I went, so hold on a minute. If I'm selling the watches, some of you have already got where this is going. I go, so hold on. If I'm selling the watches to the company, then that means I get the cash back out of that company, but I already paid tax on that cash in order to buy the watches in the first place. So essentially, I can sell a personal asset to a company, my company, and then get the cash out tax-free. He went, yeah, that exactly works. That's exactly what it works like. So,
can I add to that, Nick?
You may. You'll explain it better than I will, but that was my version of events.
Of course, it was spot on, but you didn't sell them at what you paid for them. You sold them at a capital gain, and of course you have a capital gains tax allowance, so you got some more tax-free money out of your company.
It's actually even better than what I just explained. Yeah. So thank you for correcting me and reminding me that you advised that to do it that way, and it was even better. So I think really the summary though of, and again this is Frank's thinking, and I agree with it completely. The summary is any asset you're purchasing, if you own it personally, is now vulnerable and is at risk. Whereas if you own it in a company, and as Frank showed you the structure, if that company is then, the shares are owned by another limited company, and then you own the shares in that, obviously Frank also advises to do all shares owned offshore, another layer of protection. But look, I don't think Frank could have summarised it any better at the end of his presentation. Just start. Just start. Like going from, for most of you, where you are now, to creating the structure that Frank showed on the screen is like, that is a big jump, but you could just do one thing to start. You might already have some personal assets, and you might just set up one new limited company and sell those personal, let's say it's watch collection, just sell that watch collection to the company. Already, you've just massively improved the stability of your personal wealth. Frank?
The client who had their 7-figure business going through their personal name, we sat together. It took about 10 minutes to incorporate a company through Tide. And before he left the room, he had his company with his name, and he was set up. That's a massive course correction that might have saved him 5 million quid if a Black Swan event had happened later on. So you're absolutely right, Nick. It's just some step to move along that path.
Yeah, for sure. Ben?
Talking of leverage, when we've talked about different businesses in today's event, you only have EE, and then there's the sales training company. You've invested in other businesses, but you've got low leverage because you're not involved in those businesses. So what's been your decision-making process with not applying more leverage to businesses that you might invest in? Because you could say, oh, well, I'll join your board, you can have access to my team, we've got a wealth of knowledge, we can actually really influence this potential investment there.
Yeah, for sure. So, well, first of all, one of the first realisations I had with Frank's help was almost all of my personal wealth is held in 2 companies that operate in the same industry. And so, like Frank said, he was heavily invested in property but didn't have any diversification. I have always been very heavily invested in events and training businesses, which, if a Black Swan event like, I don't know, lockdown happens, that is not so hot for live event businesses. And by the way, there will be another one. There will be. The precedent has been set. So now, at some point, and it might be a year from now, I hope not, it might be 5 years, it might be 50 years, but the precedent has been set, it will happen again, because as soon as there's any kind of health scare, then we're going to go straight back to what we know is the safe option, which I personally think is stupid. But I know that that's a risk, and so diversifying out, investing in other businesses. Now, could I leverage my knowledge, skills, team by sitting on the board of one of those businesses or giving them access to the team? Yes. And there's only so thin I can spread myself or the team. So there's a couple of things that I'm planning on doing, but remember, you can't do it all overnight. So one is to invest in or start companies that are not in the training space at all. With Frank's help, I'm building the property business. We're getting quite aggressive with that, and I'm looking for. And by the way, this was one of my actions from when Frank and I sat down recently. I am looking for opportunities to invest in other businesses. If you have another business and you are seeking investment, I am open, I am looking for those opportunities. Caveat, I'm not interested in anything in training or events, because that wouldn't help with diversification, nor am I interested in anything to do with property, because I'm already doing a lot of that. So, but anything outside of that, I'm absolutely interested because it will help me diversify further. And I'd like it to be stuff that I'm interested in. One that I'm really keen on doing is something in the health and fitness space. So, gyms in particular.
I'll let you know when we're ready.
Yeah, cool. I know you've got a supplement business, so yeah. I want to make sure we get through. It is Claire, isn't it? The light's really bright, so I can't actually see if it's you. Claire, I thought it was. Claire.
Thank you. It's actually a question for Frank, if that's okay. I'm an accidental landlord. I'm sure there's probably loads of us who end up in that situation. So I bought a property back in 2006, just before sort of highest prices, then the crash happened, etc. Met my husband, bought our house together. Flat had depreciated, so we rented it out basically, and I've had a landlord in there for the last sort of a tenant in there for the last like 15 years. What's happened now is I had a really fantastic base rate mortgage that tracked 0.5% above the base, so lived the happy life of that for a number of years, and now I'm getting absolutely screwed. So it's gone from being profitable and an asset to now costing me every single month. I'm having to subsidise it. I've panicked and gone down the route of I need to sell this property and get it out. And then I've listened to everybody here today and gone, I'm not sure if that's the right decision. So my question is, for somebody like me who's in this position, what would your best advice be, or your next move?
From here or from there, mate? Where would you want me to answer?
You come up, and I've got one thing that I want to say before you answer. And this is why Mark and Frank believe that there's so much opportunity right now in property, and why I'm going there. Because, Claire, you're in the right room to ask this question and get a good answer. But most people aren't. Most people are freaking out. And then we are able to take the opportunity to purchase those properties below market value, and therefore release people from a difficult situation where they're losing money, and then also, of course, create more wealth and more assets for ourselves. Frank?
So you only lose money in property. Nick's right to put it down here. It's very safe. In terms of safety, it's right to be down there. You only lose money in property if you buy wrong, or you become a forced seller and you sell quickly or in a weak market. And that's the second mistake you're about to make if you sell now. Now, potentially make. Doesn't mean it's a mistake for you. It may be absolutely essential you sell in order to stay afloat. So if you only have £500 a month spare at the end of the month, and this is costing you £1,000, and now you can't pay your rent or you can't buy food, then sell it, absolutely. And it will have possibly gone up since 2006, or has it still not? Did you pay that much for it?
It has. I think that's the thing. It's a bit crap over the years, in all honesty.
So when you sell it, are you going to be paid money, or are you going to have to put money in to sell it?
No, I bought it for 106. It's valued at 125, but I've just had to spend £8,000 to buy the lease. Okay, so you're going to probably break even then, there or thereabouts. Maybe walk away with 10 grand. So you haven't really capitalised, and what you did is you paid too much for it, and you didn't buy it in the right area, etc. You know, but you know all those mistakes. But the great thing is, I've bought lemons before, rubbish property investments, but because of that trajectory, it doesn't matter. Because prices go up so much, it repairs them. So if you can hang on to that for a decade, you'll make really good money from it. And interest rates might go up a bit higher, as Mark says, but then they'll come down. And rents will continue to go up, guaranteed, over the long term. So if you're in a financial position where you can swallow that, it's probably only a few £100s a month. If you can sustain that, and you've got decent income, and it's not going to make you less happy, now you have to take your emotional hat off and sit there as an investor and go, yeah, but over 10 years it's going to make me money, then I would encourage you to hang on to it. And the main reason for that is selling is costly, and buying another property is really costly with stamp duty and legals, etc. So the transactional cost, if you were to do that and try and buy something, is not worth it. So I would be very strongly inclined to hang on to it unless there's a really good reason to sell.
Question, Claire. I don't think I caught all of the context that you gave, but you've got a tenant in the property.
Yeah, I've got a tenant in the property.
And the rent that you're getting is less than now the rate, the amount you're paying out for your mortgage because of the increased rates.
Yeah.
When was the last time you increased the rent?
Well, it's got to go up. I think the issue I've got is because he's contracted, I can't do anything till September. And at that point then, it should go up by about £100 a month, which would then mean I'm not losing anything.
Because by the way, and I'm embarrassed to admit this, but it just shows like we all make mistakes and we don't know it all. I just neglected to pay attention to the fact that like market rates for rent were going up and up and up, and I just didn't pay any attention to it because I'm a very hands-off property investor because I'm actively engaged in my core businesses. And I had one that I think they were paying 500 and something a month, 595,
and it went up by 350 or something.
Oh yeah, like the market rate for that property in that area is like nearly £1,000, and I just hadn't put it up. So I was actually leaving a load on the table because I hadn't paid attention to it. So that was just another thought on that. You can say something. I guarantee we're not going to like it, but you can say something.
I don't mind.
Make it brief.
Yeah. Actually, I was in the same situation like yours. I bought a couple of properties in 2007.
Okay, I need a question, and it's got to be... No, you listen. I need a question, and it's got to be quick, for the benefit of everybody in the room.
Yes, that's what I'm trying to tell her.
Give me the question.
What I did, it's not a question. I'm trying to share my experience with her.
So your experience would be great for her. You can share it afterwards. Perfect. Thank you. Give her a round of applause for willing to share with other people. One more question. I think, Chris, you had a question?
Yeah, I nearly can't remember what it was.
I have that happen to me too.
There were so many other questions afterwards. It was about the watch. So if you're selling the watch to the limited company, does the limited company have to be a certain type of limited company, i.e. a trading company, an investment company, or does it not matter?
So I'm not an accountant. Everything I've shared today is my experience and how I conduct my affairs. I believe that the term investment company has an accountancy meaning. It has a HMRC meaning. And so I would check that with your accountant. It doesn't change, and in fact, I think Nick hasn't it, checked with your accountant.
Yeah. Oh, yeah, 100%.
And he's all cool with it. It doesn't change the structure that I had of all the businesses down here and the shares being held in a trading company above it. So that's the important bit to remember.
Okay, thank you.
Cool. And by the way, I'll underline what Frank said. Anything you've heard today, check with your accountant, because all we're doing is sharing our experience. I'm going, hey, these are my favourite wealth building strategies. They're not the only ones. You should seek advice from your accountant who's qualified and has professional indemnity insurance and all of these things before you do anything. But hopefully what this section this afternoon from Frank, from myself, from Mark has done is started to stimulate your thinking a little bit and have you think a little bit different when it comes to money and building wealth. So, ladies and gentlemen, a little round of applause once again for Frank Clay.